is that deer in the headlights look.
Simple, but not easy, I would say.
We'll always need industrial.
You can't warehouse from homes.
What 20-year period would someone not have come out wealthy after that? I don't need to have home runs. I'm fine hitting a whole bunch of singles.
All right, today we got Chad Griffith on the podcast, the industrial real estate experts. So I want to get right into it and start with, can you tell us about your background and how you got started in the industrial real estate game?
Yeah, and thanks so much for having me on the show as well, guys. I'm really excited to chat industrial real estate with you guys. So my story is probably similar to a lot of people that got into industrial real estate that didn't have family in it. And now that industrial real estate's become a lot more popular, it's becoming common for a father to go into the business or a mother to go in the business and then their kids get into it after. So they were exposed to it. I had zero exposure to industrial real estate when I first got into it. I was originally buying and selling some houses with some friends right out of university, and made a little bit of money, but nothing spectacular. Found an interest for real estate in general, so I got my license. This was back in 2004. So got my license as a real estate agent, started selling houses, and just realized that I hated it. I couldn't get behind all the emotional attachments that people had and all the emotion that people had in making decisions. And to some extent, I get it. It's a big purchase, but I just couldn't foresee that being a career, working those hours, never having time off. I just didn't see a future for it. So I thought, well, commercial real estate would be interesting. That'd be something I think I could do. So started asking around, asking for some connections. I thought I'd be working, selling office towers or retail shopping malls, like the kind of that glamorous area of commercial real estate. The office that I ended up joining in 2005 just so happened to focus on industrial real estate. And I didn't know much about it at all. It's that deer in the headlights look that if you tell people that you're in industrial real estate, a lot of people give you that look. That was my look. But it was just very fortunate and great timing that it happened that way, because I went from not knowing anything about it to being mentored by some great people. I've been 20 years now that I've worked at the same office that I started in. And funny part about it now is I now own the building that our office is in. So I ended up becoming a partner in the firm. I've started investing in real estate myself, and three other partners ended up buying our building in 2019. So it's so funny how I knew nothing about it when I first started. Fast forward, it's all that I think about now. Like I books that I read at night, it's my wife just thinks I'm absolutely crazy. Right now I'm reading a book on industrial electricity, just because I'm so fascinated about everything to do with industrial. But again, like most people, and I'm guessing there's people that are tuned into your podcast that are fascinated by industrial real estate, but they just don't know what it is. That's exactly where I started.
That's a huge success story to go from deer in the headlights to now you own the building, and then beyond that. So you've done brokerage, did that successfully for a while, and then got into investing, which is that's a path that a lot of brokers try to get on, or that we had talked to. And then you even started a YouTube channel that's grown a ton in the last few years. So all super exciting stuff.
And so what does your day look like now? I mean, so you're still involved in the brokerage side, or is it half brokerage, half investment, or kind of what's your day like now?
I would say still mostly day to day is brokerage. That's still what takes up a lot of my time. What's fascinating about industrial, and I know you guys both believe this as well, is that the management, as the amount that you have to put into managing industrial is far less than what you'd have to put in managing multifamily. So right now I have 6 properties. It's about 160,000 square feet worth of property, and mine has all been JVs. I haven't raised money as a GP. It's all my capital that I've put in and partnered with different investors in JV capacity. For the most part, we have one property in it's about 10 minutes from my office. It's a manufacturing property. It's a single tenant building, Fortune 1000 company that's a tenant in there. I haven't been to that property in 2 years now. It's they do everything. A large company that is in there. They've never obviously missed a rent payment because of just the size of their company. That's a $3 million building, give or take. The equivalent of that, call it a 15-unit apartment building, more or less, depending on what market you're in. Managing 15 residential tenants and all the things that are required and the turnover versus managing one industrial tenant that takes care of everything themselves. It's so actually easy. Well, easy is a misnomer. It's easier to manage industrial. So I still spend most of my time in brokerage. At some point, I'd like to move more into the ownership side for reasons that I'm sure we'll get into. It's been tough buying industrial. It's been tough buying anything over the last year and a half, 2 years in this interest rate environment. But assuming that things go down interest rate wise, I'd love to keep adding more. But I've been very hesitant to buy over the last 2 years as well. So yeah, long answer to your question. I still do mostly brokerage right now, but it definitely does still take time managing the portfolio.
And let's double click on that a little bit, the multifamily versus industrial, right? Because I think a lot of people, when they start in real estate, it's residential or multifamily, right? That's the world that most people start in, and a lot of people stay in that space. What are some of we already talked about kind of the management efficiencies and time efficiencies between multifamily and industrial, but what are some of the pros and cons versus, those two different asset classes?
Yeah, and I'm glad you mentioned pros and cons, because I'm very cautious to just say that industrial real estate is the best asset class. I'm biased because I spend so much time in it, and that's all that I focus on. But there's people that have made a lot of wealth in multifamily, and I still think that that's a very viable option. And I'd even go so far as to say that most people should probably steer away from industrial. We can talk about why more, but I don't think industrial is this perfect investment vehicle. If anything, it takes a considerable amount of time to gain the knowledge on what you need to know to be smart money. And I think that that's the goal of every investor, is be smart money. There's a very high risk of being dumb money in industrial if you just jump into it, see something on LoopNet that just gets posted, and you're like, oh, this could be a good investment, and it's an industrial building, and you don't know anything about it. That's very risky in my mind. So I think the average investor is probably better off not coming into industrial. But if someone is willing to put the time in, really get to understand what industrial real estate is, understand the pros, understand potential pitfalls, and then become an expert in the local market wherever they're considering, and this could take a year, 2, 3 years really to get that foundational knowledge. Then I think that there's a lot of benefits. Another option, of course, is to just become a limited partner in a syndication or a fund. I think that's a great option as well, where you're just a capital partner and you're investing behind people that have that knowledge. But the thing that I like probably the best about industrial is that you're getting, for the most part, term leases, and you're getting what's called triple net. And it can be called all kinds of different things. I've heard it called fully net, single net, double net, modified net. The language is almost irrelevant, but what the intent of it is that with an industrial lease, and this applies to commercial leases in general as well, is that there's a base rent or a net rent that the tenant pays to the landlord, and that's agreed upon for the whole duration of the lease. So if it's a 5-year lease, it's usually quoted per square foot per annum. Some markets do it per month. Again, it's nuances in different markets, but how the rent that gets paid, the net rent, that amount is agreed to. So it could be $10 a square foot for year 1. Maybe it escalates to $12 a square foot by year 5. That's agreed to. The tenant's also responsible for paying the proportionate amount of all property level expenses. If it's a single tenant building, they just pay all of it. If it's a multi-tenant building, they pay their proportionate share. But those property level expenses are property taxes, building insurance, common area maintenance, and management fees. And the thing that I really appreciate, and every multifamily investor right now is feeling this pinch where they can't pass that through. They're typically charging gross rents where all of that's included in one number, and then maybe the tenant pays utilities, but that's all included in one number. So if property taxes go up, the landlord's eating that. Insurance goes up, the landlord's eating that. In industrial, those all pass through to the tenant. So if I'm renting a space, I'll go back to that manufacturing property. If I'm charging them $10 a square foot and their operating costs usually it's estimated a year in advance, and it gets reconciled at the end of the year. But if I'm charging them $5 a square foot and the number comes in to be $7 a square foot, that tenant's paying that difference of that $2 a square foot. And multifamily right now, where you've got property taxes going up across the board, insurance is a real problem. Maybe not in Wisconsin. Like I think you guys might be more insulated, but look at Florida, look at Texas, look at California. There's some major problems going on with insurance right now. Everything's going up. So you've got common area maintenance going up, management fees going up. All of that is eroding the amount of rent that the landlord's actually receiving. So when you couple those two things together, you've got long-term leases, so we don't have the same turnover, and you've got the ability to pass through expense increases to the tenant. I mean, that's like if you're an investor right now and you listen to that and you'd say, well, that's exactly how it should be. That's what it is. But again, it's a trade-off. There's big risks that come in with that. And the easiest one would be that single tenant building that I have. If that one tenant decides to leave, I now have 100% occupancy. Whereas a owner of a 15-unit apartment building, one tenant leaves, they still have 14 other tenants paying rent. So there's pros and cons to it, of course. But if you can manage it responsibly, and that's where I think the management is really important, is I need to have a plan in case that tenant is going to leave. And typically I'll have a 6-month lead time where I'm going to know if they're going to either renew or look for other options. And then that gives me time to find another tenant. But there's all sorts of risks that come with that. So I guess what I'd really just try to emphasize on that is ears should be perking up saying, okay, well, I can get long-term leases and flow this all through. But there's also the risk on some of these buildings that you could have 100% vacancy just because one tenant says that they're not renewing. So definitely pros and cons.
Totally hear that. And that is the reason that we decided to go towards a fund model with industrial properties, just because we wanted to include more diversification across the portfolio. We really like industrial in southeastern Wisconsin, but we wanted to kind of hedge against. So we wanted to try to get the benefits of the net lease, insulating against inflation, insurance costs, taxes going up, and so on and so forth. And insurance isn't going up as much here as it is in a place like Florida. But we like the net lease, but then we also wanted to build in some more diversification across the portfolio versus buying one single. And we do own a large single tenant, 82,000 square foot facility. That same thing, right? If that goes vacant, it's not going to be a good situation, or we're going to have a lot of work to get that leased up. But I appreciate you calling that out, and I completely agree.
I was going to say, let's maybe highlight that a little bit more too, because I agree. I think the leasing is one of the cons or potential risk in industrial, right? Because I think with an apartment, right, okay, that's going vacant, you could throw an ad up on your phone, take some pictures, and you could probably get it leased up in a few weeks or a month. There's a much bigger process when it comes to leasing up industrial. So what is your, like you said, tenant gives you their 6-month notice, they're going to leave, you got that runway. What's your process look like to say, okay, we know this space is going vacant on X date. What's your process look like to get that filled?
Yeah, and that is the biggest thing that an industrial owner can do, is being acutely aware of those vacancies coming up and having a plan. Because you're right, I'll circle back to the answer, but I just wanted to double down on what you said there. That's so true with multifamily. If you have a 15-unit building, and sorry to belabor this arbitrary example of this 15-unit apartment building, but if you have a building like that and a vacancy comes up and you decide that you're going to rent it for $1,200 a month and it doesn't rent, well, you could lower it to $1,000. And maybe that doesn't do it, but you lower it to $900 and someone's going to eventually take it. You're always going to have a tenant at the right price. In industrial, it's not always the same. So this also speaks to that risk element. If you have a very specific building and it was perhaps built for a very specific use, so a company needed something unique in the building for their process or their manufacturing or whatever it was, if they made very specific modifications to that building, and there's one that comes to mind actually that I can speak to, is that there's a building that I was involved in 10 years ago or so. The owner who sold the building also had a company in there, and he only needed 14-foot ceilings for his business. So it was a beautiful building, one of the one of the nicest industrial buildings I've ever actually seen, but 14-foot ceilings. When it came time to find a tenant for that, it was very, very difficult because not many companies could do it. So there's an example of someone going in, if they looked at that building and they saw, well, this is a beautiful looking building, and they didn't know that that ceiling height would be such an impediment, it could be very difficult. So I think for this one, and we will have this tenant coming up actually in the next year and a half. So I might be going through this exercise next year. It'll be similar to selling any type of property or leasing any type of property, where my mindset is you want to take a blanket approach as possible. And you guys might appreciate the football analogy. Are you guys Packers fans?
Absolutely. Go Pack, go.
Okay, so you'll appreciate the football analogy then. I like to look at it that you need to have all players on the field when you're approaching a vacancy like this. So quarterback might be your marketing plan. So how are you actually marketing it? A lot of commercial real estate is very poorly marketed. It might go onto the company website. Maybe it goes onto a LoopNet. Maybe it goes onto something like that. I try to advertise it everywhere that I possibly can on various websites, various platforms. I'll pay for additional exposure, but really blanket marketing plan, typical stuff like signage, much signage as you can. Blast it out to all the brokers in the community. So in my market, there's about 100 guys that do industrial real estate brokerage. So send it out to all of them, offer some incentive if we have to, like a full fee if they bring a deal by X date, and then cold call a lot of businesses. So that building in where it's located, I'll get on the phone and just start calling businesses in the area and just say, hey, we have this opportunity coming up in 6 months. Just wonder if you guys have any plan for your real estate right now. Very simple call. So it's that football analogy. You can win with just a few guys on the field if you're playing a weak team, but to have the best chance of success, you need every player on the team working as hard as they can. So it's a combination of a lot of things. I never want to just rely on just putting up a sign or just sending out a brochure. It's all players on the field mentality.
I love it.
100%.
Love the analogy too.
And we lean, I would agree that we lean a lot. We certainly do our part in leasing as the landlord, right? But we also lean on the industrial brokers that are experts in that space, right? That are more ingrained in that space, that are knowing when other tenants are coming due in the area. They're doing the cold calling. So I think it's certainly, I agree, it's a team sport when it comes to leasing.
Yeah, I'd never sleep on the industrial brokerage community for wherever you are. And this isn't self-serving because I'm not in a market where 99% of the people listening to this will be. So this isn't self-serving, but the industrial brokerage community, if you can find a broker or two that you resonate with and they give you good service and they give you good intel, paying that 5% or 6%, whatever it is of the lease rate, I think I'll pay it as an owner myself. I've paid out a fair amount of fees to other brokers, and I never once hesitate on that. I just think having those guys in your corner and treating them well. If I enter into other markets, the first thing that I'd be doing is trying to establish a relationship with a couple of brokers there.
Absolutely, I agree.
Completely agree. So what are some of the other things? Because you mentioned the smart money versus dumb money, and I totally agree. You know, when it comes to industrial real estate, what are some of the other things that you look for in buildings that you would be potentially buying? So low ceiling heights is a big kind of red flag if you're thinking about how to lease that back out, depending on what's going on with the building. But what other things? I know there's like ratios for dock doors. You know, what other stuff do you specifically look for with all the experience that you have, and that would be like, yeah, this building's a home run?
Yeah, it's funny. In my entire portfolio, I don't have a single dock door, which is funny to think about. Everything is grade loading in my portfolio. It's interesting because we talked about this as well as there's different types of industrial, and that's what gets lost for a lot of new beginners, is that they look at industrial and they might be like, okay, well, it's like a big distribution center, it's a big Amazon fulfillment center of like 1 million square feet, and that's true, that is a huge component of industrial, but there's also all this other type of industrial that's class B, or it's manufacturing, or it's flex space. And that's the opposite of warehousing. Where warehousing, you've got 36, 40-foot ceilings, and they're big, wide open buildings with dock doors and a column grid that fits racking. On manufacturing, flex, Class B, whatever that people want to refer to that as, it's a wide assortment. So one building, the building that I bought with my partners of our office building, that's a flex building. It's in an industrial park, but it's got a hot tub store. It's got a flower shop. It's got a cabinet retailer. It's got an equestrian store, and then it's got our office in it. So there's really no industrial users in that building. The hot tub showroom might be the closest one, but no industrial users in there. So that one has actually got really terrible loading. It's really tough getting. The hot tub store has a couple great doors, but it's really awful loading. But they're not bringing in semi trucks. So it ranges, and my portfolio is sort of all over the board from that way. But for going forward, and still to this day, if I'm looking at a deal, I want to see generally like a relatively low site coverage ratio. I want to see some excess land on there. Vehicle storage is huge. People just want to put out a sea can, or they want to have some outdoor storage. Or you guys are in Wisconsin, so you know snow just as well as I do. We have to pile some of the snow somewhere. If there's nowhere on site to do it, then you have to haul it away. That gets really expensive if you're doing that every snowfall. So I want to see some excess land. It gives so much more room for parking. It opens up more uses if you have parking available, because instead of it just being a tenant that only has 3 vehicles, well, what happens if you find an indoor gym, or you find something that's unconventional from an industrial standpoint, but they just needed more parking? I want to have that extra yard. Also just gives more room if there is marshalling area, if someone does need to bring in a big truck. I want to see that. I'm not opposed to a single tenant or multi-tenant buildings. I'm looking at both regularly, so I don't have a preference necessarily on either one of those. I'd have to see a minimum 20-foot ceiling. I'd be pretty uncomfortable going below that. In even modern warehousing, like they're 40-foot plus now, a lot of the new stuff going up. I'm still comfortable with that 20 feet. A lot of these smaller companies or manufacturing or flex companies, they don't need ultra high ceilings because they're not racking product. So it's not as necessary, but definitely want to see that. And then the thing that I'm most conscious on right now, which was reading that book on industrial electricity, is power. I think this is just going to be a big concern going forward. I think it's going to be a massive concern going forward, is going to having adequate power for tenants. So at a high level, that'd be the things that I want to see. I like grade loading more. I just think that unless you're a distribution company, more companies outside of warehousing are going to need grade loading. So I preferably have grade loading, minimum 20-foot ceilings, power that's at least comparable with other buildings in the property, and low site coverage would be like the high level things.
I love it. Yeah, I know of a guy who runs a manufacturing business in Illinois that we'd met, and he owns a number of different buildings that they have, and we told him about our business model and how sometimes we're looking at sale leasebacks, and he had said the things that he looks for in buildings are power, air, parking, and then what he said was moving was relocate. Yeah. He was like, if you could figure out a way to put sort of relocation services within your business or partner in some way with that. He's like, some of the biggest costs I have is to move all my equipment, so I'm looking for some way to ensure that I have enough power, enough air, and enough parking. And then the kicker would be the moving thing. If you could wrap that into something, I don't know. I'm still thinking about that a little bit, but
interesting.
That was an interesting one for me too. But
what about, on that, so let's talk about like stable deals and value add deals, right? So in my mind, you could call a stable deal, it's a 10-year lease with a credit tenant, right? It's the rent's set, you're going to get a 6, 7, 8% return. And then there's value add deals, which in my mind, there could be numerous different definitions of a value add deal, right? But let's say it's a short-term lease deal, and you're going to come in and increase rents or bring a new tenant in. I'm assuming you've been involved in both of these spaces. What do you look for? I mean, are you doing a blend of both of these deals? Do you prefer, a value add deal over a stable deal, or what's your thoughts on that?
Yeah, and that is a great question. And you're right. I have been mostly towards the safer end of buying some stabilized income already. I'm not a very risk adverse investor myself. I've never bought a vacant building. That actually scares me to some extent. Although just in the nature of buying real estate, you have to come to reality that you might have a vacant building at some point. But I like buying property where there's already some cash flow coming in. So that manufacturing property that we bought, textbook case, I think we had 5 years on the lease when we bought that one. But large company, no value add. The lease was fixed for the term of the lease. So that one was kind of a coupon clipper. I would say my ideal property right now would be to buy something where I've got the ability to add value over the next 3 to 5 years. So I don't need to buy something and immediately add value. If I could find a 5 tenant building where rents are perhaps below market, or the leases were poorly written, maybe they're gross leases, so I can just convert those to be a net lease. Or if I can do something to the building, if I can make some basic renovations, or just increase rents with time. Just some of these older buildings, if you buy off a small mom and pop owner, they might not have raised rents in 20 years. So they might still have leases, but if I can mark to market just by renewing tenants, that's my preferred way of adding value, because it doesn't require as much capital. I don't have to go in and spend $1 million renovating something or fixing something. It's just naturally raising rents by seeing a arbitrage. I suppose a way of looking at it is just something wasn't correct. The owners weren't charging a market rate. So by just being patient and collecting cash flow, if I can underwrite a business plan that I can buy this building at X, and over 3 to 5 years, I can just slowly make tweaks, small incremental tweaks, as opposed to massive changes. That's probably my ideal wheelhouse, because I'm a patient investor. I don't need to have home runs. I'm fine hitting a whole bunch of singles. And if you can buy a building that has rents below market and you can just slowly mark to market, or replace, get different tenants in there, or just make small modifications, to me, you can turn a single into a home run if you're patient.
Absolutely. Yeah. Mitigating risk, right?
100%.
What about location? So you're up in Canada, and is most of your portfolio up in the Canada markets, or do you invest in the US as well, or?
It's all in Canada right
Okay.
now, but everything that I've been looking at is in the States. So
Okay.
it's Texas is probably the market that I'll go to next. I've spent time looking at that market, but as of right now, everything's in Canada. How I'm looking at markets is I typically want to be in a large city. Like I and by large, not necessarily like a New York or like one of the primary markets, but secondary, tertiary markets. As long as there's a minimum population, I'd say 1 million would probably be the number that I'd like to see. I've seen too many things over my 20-year career now where people have gone into markets too small, and it can become very challenging releasing. There's people that have made a lot of money in smaller markets, so I'm not discounting that. But for myself personally, so when I'm looking in Texas, the big ones are very challenging. It's very challenging looking at a Dallas right now or a Houston, because there's just so much competition. Those are ultra hot markets. Plus, Dallas added 70 million square feet worth of inventory last year, so there's a lot of absorption that has to happen in Dallas for that market to balance out. But yeah, like secondary markets, at least close proximity to a large market. So if it's under 1 million, I like El Paso. I like Corpus Christi. I've looked at both of those markets in Texas, and they're smaller, but it's so close to the major markets, and El Paso's right on the border, so there's going to be so much that gets built over the next decade there. Corpus Christi, major port right there. I like population growth. I think that's got to be the key driver for any market that I'd consider. Because that's what drives industrial in my mind. If you don't have population growth, it's very challenging to forecast what the next 5 to 10 years looks like. But if you have good population growth and it looks sustainable. There's reasons why the population is coming to that area, and it can continue to do so. So long as that the market hasn't recognized that yet, and there's opportunity. So whether that's reflective in the vacancy rate or absorption or rental rate growth, whatever it is, there are different ways of looking at it. But so long as there's people coming into the area, the market isn't saturated, there's opportunity to grow. I just want to find a fair market deal in one of those markets, and I don't need a screaming deal. I don't need to take advantage of anything. I just want a fair market deal where I can slowly mark to market, hold it for 10, 20 years. I've very patient money. Everything that I have, I'd actually like to own forever if possible. So if that's kind of my buy box. Good market, population growth, find a property that is under rented, under leased, mark to market over time. It's a pretty easy formula when you actually break it down that way.
Simple but not easy. I would say. I mean, that's what this business kind of is, and that's the thing. I mean, it's that's why I love real estate in general. I mean, it's not like an app or some sort of thing that I've back in the day I evaluated starting businesses, buying businesses, software companies, and you're just like, man, it's not as simple as something like this. Like you just broke down a very solid formula for buying real estate and building wealth over the long haul.
It's simple but not easy. That was a great way of describing it. And let's even paint a picture for somebody out there that they went and bought a property, learned everything about industrial, or they bought into a fund, or they bought into a syndicate, whatever it was. If you had a 20-year outlook, so you go into a market where you expect population growth for the foreseeable future. Nobody can predict what's going to happen tomorrow, let alone 20 years. But let's just assume that that's your investment thesis. And we all need some sort of thesis on where we're going to put our money and why we're going to put it there. So my thesis is let's put money into real estate for the next 20 years. And let's assume you just get a 20-year amortization on a mortgage. Buy one property for $3 million. And you believe it's in an area where there's going to be population growth and rental increases. Over that 20 years, you're cash flowing. You should be cash flowing the entire 20 years. I think it'd be irresponsible to be buying too much property without having positive cash flow right off the bat. So you're cash flowing through the whole term. You're getting tax benefits through that whole term. You're paying down principal through that whole term. And you're getting some appreciation just through inflation, if nothing else. I think it's reasonable to say that that $3 million property is going to be worth, very conservatively, could we even say like 4? I mean, it could be 6. It could double very easily in that 20 years. But let's just say it goes to 4 million. Now you've got a $4 million asset, fully paid off, no mortgage on it. But that's a pretty, in my mind, I said this to someone the other day, if someone goes and buys real estate responsibly at scale, I don't think you could do it enough if you just went and bought one house as a rental property. But if you bought a sizable asset and you held it for 20 years in a good market, it's impossible to not get rich after 20 years.
Yep.
But it's very difficult to get rich after 1 year. So but how do you mess that up?
Yeah.
You look at any 20-year stretch in North America's history of somebody that would have went and bought a property, held it for 20 years, cash flowed the entire time, and had it owned free and clear. What 20-year period would someone not have come out wealthy after that?
Yeah.
And that's a good segue into, let's talk about from a macro view, what are some of the tailwinds the industrial real estate sector is seeing now and is going to see over the next 5, 10, 20 years?
I think the biggest one is that it's the curse of growth, where industrial has been sleepy for a long time. When I got into it, very few people knew much about industrial at all, me being one of them. But very few people had any idea about it. Fast forward to today, and everybody has seen these big distribution centers go up on the highway and they're by the airport. All of a sudden, industrial, which has been like this nascent industry tucked away in an industrial park by design, has now come into the actual spotlight. You just see it everywhere. So I think that industrial runs the very real risk, and we've seen this in numerous markets, of just overbuilding. And if it wasn't for interest rates, I think we would have been continuing to overbuild just because developers need to deploy money, banks need to lend. That's just the whole system revolves around activity. The whole economy evolves around activity. So if office doesn't look great right now, retail, I don't know if there's a big appetite to go and deploy a lot of capital into retail. Multifamily, same thing. Rents seem to be kind of flat. I don't know if there'd be a big appetite to build right now outside of industrial. And that's why a market like Dallas had 70 million square feet go up last year. And I think Phoenix is leading right now, and they still have 40 million square feet going up. So there's a lot being added to a market that can't support that type of growth. And it just happens. It happens in every real estate cycle where there's all these signals saying demand is going so crazy. And it was fueled in 2020, 2021 when there's this massive move towards e-commerce. And everyone thought, well, these 40% projections are just going to continue forever. So let's just go and keep adding to try and keep up with it. When in all actuality, there was a big run up, but it's not sustainable. You don't just see a 40% increase year over year forever. It does balance back out, but the development cycle takes much longer to recognize that. So I think that's the biggest tailwind that we see, is that there's just going to be a glut of inventory that we have to work through. Fortunately, I think that's tailored almost exclusively to the warehousing distribution side. That's the big 300,000 square foot big box industrial buildings. There's been very, very little new inventory added in that Class B sector or in the flex space, where it's like a home services company or an art gallery or someone that just wants to have a space like that. There's been very little of that inventory added. So I think that will be somewhat insulated, but there's challenges with the current amount of inventory that's been added. Where there's some relief though as well is that interest rates have also caused new projects to get delayed or postponed. So we'll probably hit a point maybe this year, maybe early 2025, where new product developments kind of stops. And then hopefully the market keeps picking up and maybe interest rates come down, maybe 2025. I have no idea even on that. That's a loaded question to even try to address there. But I think that for the next year, I think that'll be the story that dominates headlines in the industrial sector, is that we'll see upward pressure on vacancy rates and probably some flatness on that. And that's going to be, that'll be blanket statement. So they'll just say industrial lease rates are getting crushed, or industrial vacancy rates just went up 400 basis points. It'll group all of industrial into one, when in reality, it's just going to be that half sector, call it, of warehousing. But that'll paint the whole market with the same brush. So I would say that that's what we all have to be prepared for, is that if you're dealing with a bank or you're dealing with an investor, you're dealing with somebody, they're going to say, well, I heard vacancy rates in industrial just went from 4% to 7%. Like, do I really want to get into that? So I think that'll be the storyline, is that's something we're just going to have to find data to support, saying, yes, that has gone up, but that's gone up on warehousing, whereas flex manufacturing, Class B, has actually gone down or stayed the same, or whatever the narrative is at the time. But that's what I think is the biggest tailwind coming to industrial. Otherwise, I think, like, I'm very bullish on it. I think industrial has 10, 20 years of phenomenal growth coming ahead of it. We have so much population coming into North America. You might even say a problematic amount of immigration coming in, with some of it being unwelcomed and unwanted. But that's a policy decision way above my pay grade. But there's so much immigration coming in. Population growth is what's driving industrial to a large extent. Reshoring, onshoring, more jobs, more production, more manufacturing. The CHIPS Act, that $50 billion allocated towards high-tech manufacturing. It's going to spur not just that sector, but all the ancillary jobs and production and manufacturing that's required to support that. I'm very bullish. I think the industrial market has got a long runway ahead of it. There'll be some blips, I think, in the upcoming years. but in the foreseeable future, I'm just very optimistic on the sector as a whole.
And one thing I like that you called out the different sectors and looking at the data based on the sector of industrial. Another thing you touched on a little bit is size of the buildings, right? We had a call with an investor and they said the same thing. They're like, oh, I just saw this report that said vacancy upticked a couple percent. And we said, well, look at, the size ranges, right? So our fund focuses on 20,000 to 150,000 square foot properties. And if you, like you said, I mean, you drive down any major interstate in most cities, you're going to see a bunch of big box warehouses going up that are generally 250,000 square foot and up. And that, one of those vacant is gonna drag down the numbers of lot. And you don't really see, they're not building, or on a smaller scale, they're not building as much 50,000 square foot warehouses, right? And that's our whole investment thesis as well is, hey, if you look at the demand for these spaces and the vacancy rates, it's very tight in this size range. So it's been our thesis. So as you looking on the investing side, does that line up with what you're looking as well? I mean, are you looking at that big box stuff? Are you more so like, what's your square footage preference?
Yeah, I personally don't have any interest in chasing that large warehouse space. Even if I did have the capital to go and try and chase a 50 million square foot building, the caliber of competition in that space is very intense. You're going up against a Prologis, largest industrial real estate owner in the world. They've got 1.2 billion square feet. Their resources and their boots on the ground and their intelligence and what they're doing, I can't compete with that. Like that'd be like me trying to start an online bookstore to compete with Amazon. It'd be in the same comparison. I'm not ignorant or naive about how well positioned those guys are, and I can't compete with that. I'm with you guys. That buy box. I'm even good with smaller properties. Smaller in terms of like smaller bays within a larger building. I've got one building. It's roughly 27,000 square feet, but each bay in there is about 2,700 square feet. Mm-hmm. So we've got one tenant that has 4 of the bays, and then some of them are leased individually. I'm not even opposed to smaller bays like that. But yeah, to make sense of it, probably the smallest that I'd go on a building is 10,000 square feet. But I'd want to have, for something like that, I'd want to have some yard. So it'd almost be like an industrial outdoor storage play as opposed to just being like a small 10,000 square foot building on an acre. But yeah, I wanted same thing, exact same buy box you guys are pursuing for the same reason. Is competition in that space is nothing like it is in the big box warehousing space, and that inventory has been relatively fixed. It's there hasn't been a lot of new flex space being added. There hasn't been a lot of like smaller manufacturing local company space being added, and the stuff that has been added, the cost to do it requires a rental rate 30-40% above what the current market is. So for all these companies that don't necessarily care to be in a brand new building, they just want to have a roof over their head so they can make their product, they're not going to pay a 40% premium. So there's almost a natural moat around that existing space that it's so much cheaper than replacement value that it all goes into that investment thesis, which I'm completely agree with what you guys are saying on that, is buy in a market that buy in a market that you like, buy in a market that you think there's going to be population growth. If you've already buying something that's below replacement value and you believe that you can always have that rented and you hold that for a long enough time, it's simple but not easy.
It is. I love simple 100%. But not easy. That's the theme.
And you said the moat. So I've heard you talk about this a lot on your podcast, and I love the way you break it down. I was going to quote you on one of your. So explain that moat that you're talking about.
I think the easiest way to look at a moat is having you're protecting your downside risk. So that'd be another thing that I'm a big believer in, and should have even started with that. My biggest thing is I try to mitigate my downside risk before I even look at anything. So before I start building on a pro forma and looking what 10 years can be and start pulling different levers and manipulating numbers to try and make a pro forma look as good as I can, I'm looking at downside risk first. And that downside risk is exactly addressing that moat. If I can buy something at a cost basis where I know that if I had to just lower rates a bit to get a tenant and I'm buying a property that's going to be generally appealing to the most amount of users, then that's my moat. And the replacement value is probably going to be the biggest thing. If I'm buying a 30-year-old industrial building in an area where there's just demand, there, especially if you're going to be inside city limits. I don't know what Milwaukee's like, but I'm guessing those big box industrial buildings are now pushing outwards, probably getting into the suburbs, because there's just not a lot of land available in the inner city. And inner city, does Milwaukee have like a ring road, like a big road that almost creates a natural boundary for it?
Yep. I-94, yeah, absolutely.
So I'm guessing everything, that big box is kind of outside of that then, right?
Yes.
Yep.
So, and that's the problem, especially in markets where there's unlimited land. So in coastal markets, Los Angeles, New York, Vancouver, very hard to actually build anything because they've got geographical impediments, mountains and oceans and everything. It's just, you can't add much. But if you're in a market where you can grow in any single direction, and this is what happened in Dallas, you grow every direction in Dallas, then all of a sudden, how much competitive advantage, how much of a moat do you have if someone can just go and build 5 minutes down the road from you because there's unlimited amount of land? That's becomes very risky in my mind. Unless you're getting that property at such a good deal and you've got a long-term tenant in there, you're at risk of just a new building coming up. So you buy a warehouse that has 36-foot ceilings, and 5 years from now, the new standard is 44-foot ceilings. You now have some functional obsolescence, even though you didn't even know about it, because at the time, 36 was fine. In the existing class, if you're buying a building, and 20 feet is probably, like I mentioned, probably my lower limit on what I'd want to go, that's just what all those buildings are. So it's not like anyone's building something across the street from you that has 30-foot ceilings. And if they did, I might have bought it $125 a square foot. It might cost $250 a square foot to build that one new. Is a tenant going to pay double the rent to have 10-foot higher ceilings? I don't think so. I mean, that's a huge markup. So that's my moat. My moat is buying a property that it would cost so much more to take a tenant away from me. All things being equal, I want to just be competitive with the market. If the market's $10 a square foot, that's what I'm going to charge. So I'll always compete with buildings that are similar to mine. But a moat will be someone that wants to build something new. That's going to cost them considerably more than my cost on it. So I again, like, it's reinforcing to me my investment thesis on this as you start looking at, okay, well, yeah, you're right. It's so much more expensive to build. There's land constraints within the market. So there's even a case to be made that the value of your land is increasing, even if the building doesn't do anything, just because now residential development, retail development, everything starts pushing out as well. And that inner city land within that outer boundary, call it, it just becomes more valuable by nature as well. So that's, I don't know if does that answer the question on kind of like how I think of the moat?
Definitely. And I just remembered on that subject, one of your podcasts, and I might butcher the exact word of what you said, but you said something along the lines of industrial is the cog of the wheel of commerce, I believe, as you said something along that. And I just want to maybe break that down. And what exactly did you mean by that when you said that?
Yeah, and this is what I've come to really love about industrial, especially if we remove the warehouse side from it from a second and just look at it from the standpoint of being flex, class B, of manufacturing. These buildings are very versatile, and they can just, not only are they so imperative in the grand scheme of commerce, greasing the wheels of commerce, or the cogs in the, I can't remember exactly what I said, but that sounded right. The cog in the wheel of commerce. It's so important that we all need industrial. And when we look back 2020, we all know what happened in March when offices were vacated. They were intentionally vacated, and retail were forced to be closed. Industrial kept ticking along, and nobody batted an eye. Nobody said anything about industrial, about saying, oh, well, they've got to close down, because that's what actually keeps the economy flowing. So we need industrial. We'll always need industrial. As long as things need to be stored, as long as things need to be made, as long as things need to be sold, it's going to involve industrial. So that's what I love about industrial, and that'd be another criteria that I'd have in industrial, is that it needs to be versatile. I don't want to get a space that is only suitable for one company. Even though I have some of those in my portfolio, what my preferred option is just a box. Call it like a 10,000 square foot box where someone can go in and they can do any number of different things in there. And that one building that I mentioned, it's an industrial building, but it's a flower shop and a hot tub store. Like there's so many different uses. And what I think industrial will keep getting more attractive with is some office users that just want to have office space, but they don't necessarily want to be downtown and they don't want to pay suburban office rates. Well, you could probably go to an industrial building and pay significantly lower rates, and you might be able to have a small garage in the back where you can put storage in there. So I think it'll be much more appealing to office users going forward, and I think it'll also be more appealing to retail users for the same reason. Retail rates, in my market anyways, tend to be double to triple what industrial is. But if you can find an industrial building that has access to major roads, perhaps it's on a major road, and you can get your rent for a third, all of a sudden industrial looks pretty appealing there as well. So I look at industrial as being the Swiss Army knife, where it can accommodate so many different types of uses. Not all industrial buildings, but most industrial buildings can accommodate a lot of different types of uses, and they're necessary. It's not even a nice to have. Like a lot of people right now would say it'd be nice to have an office. We have everybody working from home. You can't make stuff from your house. You can't store a bunch of inventory and crates and pallets. You can't store that at your house. Industrial is necessary. It's imperative to have it in our economy.
One of our broker buddies always says you can't warehouse from home. So it's exactly what you're saying. It's always going to be needed. It's always going to be needed.
Yeah. No, it's so great to talk to you about this, and it reinforces our thesis as well. So I'm getting even more and more confident about it. And I mean, we're working on a lease right now with a guy it's an flex industrial space right on a main drag, and this particular space, this guy is going to be selling like car parts and paints and auto supplies and different things like that. And he wanted to be on the main drag. He didn't want to go pay retail prices, and he's ecstatic. We're ecstatic, and it's like just makes a lot of sense. There's the versatility in some of these buildings is huge. So I completely, wholeheartedly agree. I do want to be mindful of your time. I think we've got to get to wrapping up here, but do you have any advice for beginners? There's a lot of people that are in real estate that listen to our show. Not a lot of people, but hopefully a lot more will start listening. But we got people that are big into residential real estate, big into multifamily. If somebody wants to start really getting going with industrial real estate, I know you have a great community called Industrialize. I'm a part of it. I haven't spent enough time hanging with you guys, but I will get on that going forward. But what would you do if somebody was a young Chad Griffiths and they were deer in the headlights like you were talking about, and they wanted to get going, like learning industrial, and they believed in the thesis?
Yeah, it's a great question. What I would actually do if I was starting again is I would actually invest with a group like you. I would get in either with a syndication or a fund and follow everything that they're doing. So how I would do it, I'd make the minimum investment and say, I just want to start. It's hard to really commit to something unless you have some skin in the game.
For sure.
So whatever the minimum investment is, that's what I'd be deploying. And I would just be a sponge. If you didn't have the capital to invest, then I would still be a sponge, but I would be just trying to read and digest everything you possibly can. So it's two paths that you have to go through simultaneously. You have to start understanding what industrial real estate is, and we've covered some of it, but that's just touching the surface of it. There's still so many more things to know. So you got to really understand industrial real estate at a deep level, and then simultaneously you need to become an expert in the market. What are property values right now? What are lease rates? What's the difference between a lease rate on a warehouse outside of the city boundaries and a Class B building that's a tenth of the size. You have to understand all of that at a very deep level so you can actually compare apples to oranges. Because industrial real estate, some people just think that it's like one broad term, but there's such a big difference between a 300,000 square foot warehouse and a 2,000 square foot flex space. So understanding all of that, and that, even though that sounds obvious, you still need to actually do it. You still need to actually understand everything that's going on. So that'd be my advice: is find someone to invest with, whether it's a fund, a syndicate, another investor that just wants to JV, that you can be a capital partner and you can learn everything from them. I think having some guidance at the beginning is a shortcut to success, because it's difficult to do it yourself. I was a broker for 10 years before I made my first investment, because I needed to save up the money to be able to deploy it, but also I wanted to be comfortable that I could avoid making the wrong decision. So that's what I'd say: partner with somebody, invest in a fund, invest in a syndicate. If someone who's in Milwaukee, it'd be crazy not to talk to you guys. If you're in a different market, there's syndicators and funds operating in other markets as well. So find a market that you're interested in, find people that you can learn from and follow along with and get a sense for how they're doing it, and just commit to becoming an expert in it. And if you're not willing to do that, just avoid industrial altogether. Just stick with multifamily, or stick with the stock market, or stick whatever it is. There's plenty of ways to get wealthy in this industry as an investor. But I think that if you have an appetite for industrial, and all three of us are passionate about it, you can probably, if you're listening to this, you can just tell that we're passionate about it. If you share that passion, you're willing to spend time and really learn it and have a long-term outlook. Again, I think it's foolproof, provided you can spend 20 years in it.
I love it.
Absolutely.
I love it.
And
Well,
before we jump off, I just want to plug your podcast as well. I mean, if you're listening to this and you want to learn industrial, his podcast is the best for just really getting into the weeds on how all this stuff works. I think
hands down,
we scratched the surface on a lot of these things, but you have like specific episodes for each of these things we've talked about. So I think certainly go check out his channel. We'll plug it in the show notes below. But yeah, appreciate you having me on, Chad.
Yeah, that was an awesome discussion. Got a great question, guys, and I just loved chatting about this. So thanks so much for having me on as a guest.
Thank you so much.